I'm here with a very special guest today, Mr. Jeff Deist, president of the Mises Institute from Alabama. And Jeff, thank you very much for being willing to come on and talk about some of our favorite things, sound money, politics, and what's really going on with inflation. For those of you who don't follow Jeff, Jeff is a freedom lover. He is obviously associated with the Mises Institute, who is bringing the principles of Austrian economics, sound money principles, and reasoned politics into the worlds of Canadians, Americans, and everybody around the world. Quite frankly, Jeff, thank you very much for joining us.
At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Today, we're scheduled to talk about inflation, this great, nefarious inflation that's going on. And I think for a lot of our viewers, they hear the narrative. Media, politicians are talking about how this is only, it's got to be this Ukraine invasion, or it's got to be greedy business people. I mean, I can't tell you how many times we've heard that. I'd love for you to just maybe open up our conversation here today, just with a little bit of conversation about what is the real cause. And we see the effect of inflation is rising prices, but can we talk about the cause of inflation?
Well, it is murky, unfortunately, for a lot of people. And I think it's intentionally so, because we've made the concept of creating money and credit, I think, more opaque and more complicated than it really needs to be. And central banks are at the heart of that, because the average person doesn't wake up in the morning particularly want to spend their time studying central banks or listening to their press conferences or reading the minutes of their meetings or whatever it might be. And your listeners will forgive me if my perspective is a little more U.S.-centric. Obviously, I follow the Fed more than the Canadian central bank, but the principles are the same in both. And so when we look at inflation, and a lot of people now are looking at it directly at the grocery store, at the gas station. I don't know if you've been eating fast food lately. I went into a little, not a big Walmart, but a small, what they call neighborhood Walmart where I live last night, and there was virtually nothing in the chicken section. There were no chicken breasts whatsoever. I ended up buying some of those little drumsticks because it was very sparse. And so you look at that sort of thing and you realize that there's a lot going on. It's multifaceted. So, sometimes free market people, Austrian economists are portrayed as oversimplifying inflation. And there might be some truth to that, because this is clearly multifaceted. There's a lot going on in the world. There's a very complex world economy. And at the end of the day, you have goods and services and, available, and then you have demand for those goods and services. And at some point, that determines the price of something. So we all understand that conceptually. But underneath is where central banks are working in ways that make things cost more. And when I say cost more, I mean go up in price, consumer price, to us normal people, faster than our paychecks go up, or our business earnings go up, or our investment earnings go up. That's the key. We don't want to focus on nominal prices or nominal GDP or nominal anything. We want to focus on real. So there are basically three kinds of inflation. So here's the kicker. There's price inflation for consumer prices. There's asset price inflation, which we think more of as equities and bonds and real estate. I mean, you're at ground zero of the, in Vancouver, of just a crazed housing market. And that's been going on for quite some time. That's not just since COVID or just since the problems of the last couple of years. And then finally, there's monetary inflation, which is at the core of all this. So really, since the crash of 07 and 08, not just the U.S. Central Bank, the Canadian Bank, the ECB, the Bank of Japan, central banks around the world have basically gone crazy with money in terms of creating new money and credit. And they all have their own mechanisms, maybe with the particular nation's treasury, in the case of the United States. But nonetheless, they've been engaged in a process of creating more money and credit as a response to that economic crash. They said, well, we can't let everything fall to pieces like it did, let's say, in 2001 or 1987 or 1929. In my opinion, this was a
etc.
gross and very harmful overreaction. Recessions are often actually the cure for the problem, not the problem to be avoided. And that's just an ugly truth. And politicians don't much like that. They'd rather paper things over and kick the can down the road. But since we've had so much new money and credit come into the marketplace, and by that I mean to commercial banks, that's what asset purchases are. When central banks buy assets from banks, they end up with lots and lots of reserves. And sometimes there's direct fiscal stimulus. In the United States, for example, just in the last couple of years in response to COVID, both the Trump, that was a Freudian slip there.
It's kind of like his
Trump
Freudian slip the other day about the
administrations.
Iraq thing.
That wasn't a slip. That was a gaffe is when a politician says something true. But they've created so much new money on the fiscal side that's directly in people's pockets. And the goods and services just haven't caught up. I mean, you look at Vancouver, and there's just more new people and more new money and credit than there are, let's say, available condominiums. So the price rises, and in some cases radically. But it doesn't rise evenly across the economy. So you have different kinds of goods and services. Obviously, stocks and bonds are different than houses, which are different than chicken at Walmart. These are very different assets. And so the thing about money is that it's never neutral. It flows out in the economy in uneven ways over time and over area, the area of the economy. So some people actually get very wealthy at the outset of an inflationary syndrome. So the idea that, this is harmful for everybody isn't quite true. There are actually people who benefit quite handsomely at the beginning of an inflationary period. So when you combine what happened in 07 and 08, where central banks just hugely increased their balance sheet, with what happened in 2020 and 21 with respect to COVID, and then on top of all that, you have these lockdowns and supply chain issues, which is absolutely global. I mean, everything you buy at Walmart, half that stuff came from China. A ship coming from Shanghai takes weeks to reach here. You throw in fuel costs, you throw in lockdowns, you throw in shuttered factories, and it's just a perfect storm. It's a perfect storm of diminished supply and way more demand. So, of course, prices have to rise. But ironically, in a very perverse sense, governments we know they like some inflation. They don't like too much because it gets voters mad. But they like as much as they can get away with because it makes GDP look like it's going up. Right? I mean, when there's more expenditures, they say, well, that's what makes an economy go. When people consume more, and if chicken costs $10 instead of $8, it gives the appearance that they're consuming more. But consumption isn't how you get wealthy. You get wealthy through production. And that's really the tragedy of 20th century economics, is that we decided that consumption was how you develop a wealthy economy. And so if you believe that, inflating money and credit kind of makes sense within reason. But if you believe that production is the key to everything, you desperately need a stable money so that entrepreneurs and savers can accumulate capital and know what the hell they're doing with respect to the future, to have some certainty about costs down the road. So inflation is absolutely demoralizing to savers, and it's absolutely ruinous to those entrepreneurial people that we all depend on to go out and create and improve goods and services. So boy, oh boy, we're in a real pickle right now, and I'm not sure that there's much of anything that can be done in the short term to save, let's say, Joe Biden and his party in the midterm elections in the United States. I think we're in for a pretty rough go for probably at least 5, if not 10 years.
And you touched on a lot of points, especially the Keynesian trap, where politicians become enamored with buying votes for people that are benefactors of those things under the guise of maybe saving jobs, or, hey, we need to bail out this company, or, well, where are you getting that money? Well, we'll just print it, or we'll just sell these bonds. And if nobody on the public market is buying those bonds, and of course, in steps the central bank in order to procure those assets. One thing for sure is Cantillon, who I recently heard on your podcast, that you were describing the uneven effects of inflation. Wondering if you can maybe touch on two things. Number one is how inflation hits different asset classes at different times. For example, it tends to go to more tangible assets first before it hits commodity prices. And the second thing is for some of our viewers who haven't maybe read Mises' theory of money and credit, maybe you could give us a simplified, because of course, nobody, your average listener or reader isn't picking up, human action, economics being the dismal science, of course. Can you maybe touch on his theory of money and credit and how this is the difference between money and currency, maybe even?
Well, Theory of Money and Credit is probably the single best book on money ever written. Some of it's a bit dated now. It was written over 100 years ago. So some of the discussions of the classical gold standard are interesting, but unfortunately no longer applicable to our current situation. But the key point which Mises makes right at the beginning of that book, actually in the introduction, is he says the most important thing to know is that an expansion of money and credit in and of itself does not bring a single new good or service into existence. So no matter what the Canadian Central Bank does or the Fed does, that doesn't mean that there's any more Honda Accords available for you to go buy, or any more chicken at Walmart, or any more anything, right? So the idea that money is wealth just isn't true. Money ought to represent purchasing power, right? So money has a specific function in society to act as the most tradable commodity. And when it's fluctuating in value rapidly, especially declining in value rapidly, that compels people to go out and spend it and get rid of it. And that's, that can appear like economic growth, but it's really not. It's just people trading one thing for another because they think that their money's getting worth less, so they'd rather have that refrigerator or that car or something tangible for it. So when this process accelerates and government really starts printing and creating money, then we see episodes throughout the 20th century, for example, like in Weimar Germany, like in Argentina, like in the former Rhodesia in Zimbabwe. So this isn't theoretical. I mean, we have real world examples of this. And of course, we have to pray that this never happens to us in the West, that we have what Mises called a crack-up boom, which makes us all a lot poorer, a lot faster when people ultimately really start to worry about the value of money and it really starts to become worthless rapidly. I mean, ask the Venezuelans what that is like day to day. And of course, as you mentioned, when the Fed is there as an implicit backstop to buy up Treasury debt, that is an enormously distortive factor in the whole economy, because that basically means that Uncle Sam can borrow and borrow and borrow and spend and spend and spend. And in 2020, in this country, in the United States, Congress spent about $7 trillion. Remember all that stimulus? About $7 trillion. It brought in taxes, Uncle Sam, about $3.5 trillion. So literally, the U.S. government spent twice what it brought in taxes, roughly. Now, that's a pretty neat trick. That's pretty fun while it lasts. I mean, if the limit on your credit card keeps going up, but you have to imagine that there are natural limits on that, even for the issuer of the world's reserve currency. And I certainly hope it doesn't come to this, but I fear that could look an awful lot like the crack-up boom, which Mises discusses in his book. So, currency is a real thing. That's a tangible thing that you can hold in your hand. But once electronic media came along, it was very, very easy to create dollars out of thin air. You don't even need to print them, with paper. And then beyond that, it was very easy to create money substitutes in the form of checking accounts and savings accounts, and even some bonds like a Goldman Sachs bond or a U.S. Treasury almost begins to take on money-like functions. And so you get to the point where, unlike back in the old days and the gold standard Mises described, we don't really even know how much money and debt and credit is out there. We don't really know, because if you go to a place like Rocket Mortgage and originate a loan, you can buy a house and nobody made a deposit. Nobody deposited money with Quicken/Rocket Loans. They just gave you electronic credits to go buy a house. So this is increasingly the case across the West. And this is what makes our earlier topic of inflation so hard to understand for a lot of people, because it's multifaceted and there's so many levels to supply and demand. But as for Cantillon, I mean, it's very simple. He was a famous French economist, lived in the UK, and he observed, and Mises is elaborate on this, that, when you inject a bunch of new money and credit in the economy, some people are closer to the spigot, you could call it, like a faucet.
Yeah.
And so they get that new money earlier, and they're able to go out and spend it before prices rise generally across the whole economy. And prices never rise evenly. There's always supply and demand for anything. When steak goes up, demand drops, and then people buy more chicken. There's all kinds of ways that supply and demand work that are not necessarily part and parcel of monetary policy, but they're reacting to it, right? They're reacting to the conditions or the inducements created by monetary policy. So, we could generally say, without being conspiratorial or anything, that the banking class avails itself of new money earlier and sooner than average people. And so the people who tend to deal with price inflation in the most difficult way are people who have lower incomes, the people on the lower rungs of the economic ladder, and also older people who are just on a fixed income and trying to save. So for them, a 5 or 10 or 20% increase in gas and groceries is very, very, very harmful, because they're not really out there making money. And so that's loosely how we might describe the Cantillon effect, is that new money and credit creation enriches some people at the expense of others. And the beauty of it is that you don't have to put on a ski mask and go into a bank and tell everyone to get on the floor and steal their money. You can just be a central banker. You can just be a Goldman Sachs guy. Now, this doesn't mean that these people are ill-intentioned and they view their jobs as some form of criminality or theft. I'm not alleging that. What I am saying is that it has that effect. And to an extent, all of this is on us, because we've allowed this state of affairs to come about, because we thought central banking is too technical, or we can't understand that. And that's for these really wonkish economists, PhD types to deal with. And we should just sort of go along and worry about the weekend baseball game. Well, I understand that, but here we are.
Give them bread and circuses and they'll never revolt.
Yes.
So in terms of being closer to the spigot, and how different asset classes, if you will, or different commodities or things, Cantillon certainly, in your prior podcast, Cantillon certainly was a proponent and did very, very well, and was probably, we think, was murdered based on his use of money back in the day. But talk to me a little bit about why. And I don't think this is a unique to our era. I think blaming greedy business people has always been the function of the root, what the media or politicians are trying to point the finger at as the causes of inflation. Any thoughts on that, Jeff?
Yes, I think the greedy businessman trope is just a wonderful cop-out for politicians. We don't talk about greedy politicians. Some of our politicians are always fighting to help people. Well, I mean, if you look at how a lot of them do upon leaving office, they suddenly find themselves doing pretty well in life. So you have to wonder about that. But the idea that businessmen can charge more than they ought to, that mentality just stems from a very ignorant view of economics itself. I mean, that's only possible in an anti-competitive or non-competitive situation. And we all understand that. And I mean, for all of its faults, the West, particularly I would say the U.S. and Canada, we're pretty darn competitive on the supply side. I mean, we have a lot of smart people out there hustling, trying to undercut, trying to disrupt, trying to find new businesses, trying to shape old businesses. So that's not the problem. Oil executives didn't suddenly find themselves more greedy in the morning because Vladimir Putin decided to invade Ukraine. I mean, everybody knows that's nonsense. So that's just a political cop-out. But I think what's so important to understand is that there is a political and banking class across the West. They do exist, and they do tend to do things which benefit themselves, right? That's not a conspiracy. That's just self-interest. If you ask a surgeon, should I have surgery on this knee or should I just rehab it? The surgeon's probably going to say, well, surgery, right? Because that's what surgeons know. That's what surgeons do. So it's a lot like that. There is a class of people who have us all convinced that money has to be a complex tool. It has to be a political and central bank tool, and it needs to be manipulated, and interest rates need to be manipulated rather than set by market forces. And so one of the great tragedies of this is that for the first time, really in a long, long time, with interest rates this low, average people cannot simply have a safe checking or savings or money market account. And because they're getting maybe 1% a year and real inflation's 8, 9, 10, Peter Schiff says 15%. So you'd be losing your shirt to inflation. So at least if you go back to the 70s, our grandparents, they could go have a simple little savings account at a local bank and get 15 or 18% on that. Yes, there was rampant inflation in the 70s, don't get me wrong, but on the savings side, you could still save. But since really the late 80s with Alan Greenspan, but especially since the crash of 07, this relentless forcing down or attempt to force down interest rates by central banks in the West, that has a huge impact on all kinds of other markets, like housing in Vancouver, like FANG stocks, because people have to go out and chase yield. They can't get yield simply by being thrifty, by making more from their job or their business than they spend and putting aside the difference. They can't do that anymore like our grandparents could and retire comfortably. They have to go out there and try to find yield. They have to go out there and figure out, hey, Tesla is going up 7% a year, so I'm going to put money in Tesla, because if I just leave it in my Vanguard money market, I'm getting 1% and inflation's 7. Inflation's 8. I'm a chump. So think how distortive that is when we look across the economy as a whole. You have all these pension funds, all these mutual funds, and their investors are, the archetype little old lady, or it's a school board or a university endowment, or these very, not in the political sense, but very conservative people. And they just want to keep their money growing a little bit. And so since they can't do that in simple ways, they have to go out and get into all kinds of more complex stock picking, which is just a non-starter for the average person. I mean, picking individual stocks is very difficult. So you're left with maybe an index fund or something like that, or but a lot of people say, well, I want to buy the FANG stocks because they did so well, and that's fine, but that's not something an 85-year-old ought to be forced to do, and that's what really I think is such a cultural issue. It's a cultural and social issue. It's not just an economic or monetary policy issue. This policy of inflationism and money creation, it really erodes and degrades society top to bottom, because you're creating, on one side, what you might say is some unjustified or unwarranted wealth, and then on the other side, you're taking people's wealth away through inflation, which makes them go out and want to spend more and consume more, because why not? Saving is for chumps. So it's really, I think if we can get people thinking about money in ways that aren't dry or technical, then I think as a society we'll benefit, because maybe people will, like your clients, for example, obviously they want to safeguard their net worth. They want to hopefully grow their net worth. They want to make investments. They might be involved in IBC, whatever it might be. But if none of this matters. No return matters unless you're considering it net of inflation. And that's, I think, where we tend to look at the numbers, but we don't look at the bigger picture.
And I think that really speaks to a big point, Jeff, is a lot of people think, okay, well, I could become an Excel millionaire because the numbers work. But then there's this speculation that's because really there's no committee or person that could ever possibly coordinate the buying decisions of hundreds of millions of people in an economy such as the States, or definitely 37 million people in Canada, 38 million people. So you have literally dozens of multiples of transactions. And to say that, oh, the Bank of Canada, this intellectual fallacy that one person can ever make these decisions, I think the net return is just as important as the net after tax return. And a lot of the things that we do up here in Canada, because we are very punitively assessed on our tax. The top marginal tax rate in British Columbia, where I'm recording this from, is 53.5% federal provincial, but that doesn't include the other taxes. We have property taxes and fees and consumption taxes and all these other taxes that are literally layering on dozens of other taxes onto somebody's spending. So what we really feel here in Canada is, yes, you need to, number one, overcome inflation, at least even marginally. You need to be getting invested in other tangible type assets, because if housing, as an example, is going to create wealth for the few, then get into maybe some real estate, or maybe some bullion, or maybe some other alternatives that are going to produce that. But then also, if you can earn, say, 4% on your cash, but then you're not paying any tax on that because we're in a tax exempt environment, well, your real rate of return at a 53.5%, it's about 8%, that you need to go and seek alternative returns. So, wealth inequality, one thing that you just brought up there, inflation does create wealth for the few, and for all the rest of it, they suffer, especially lower income people who now, if they're $200 away from bankruptcy. I think I just read something about that in the Globe and Mail, big national paper here in Canada, was that most Canadians are $200 away from, or 40%, or $200 away from bankruptcy. So if their costs are going up, they now have to look at alternatives. Maybe I'm going to pick up that bicycle instead of taking the car to work. And so we relieve ourselves of more opportunities when we allow the state, through either the Bank of Canada or the government of Canada, through their altruistic decision-making process, to interfere and intervene in our lives. What is the possible solution to inflation long term, and do you see that things in North America are going to come to a soft landing, or are we going to experience some prolonged inflation? What are your thoughts?
Well, the only soft landing is an exceedingly long, drawn out one. In a sense, we're still having a soft landing from 07 and 08. We've never really reckoned with the debt and the money and credit expansion from that episode. So a soft landing is what they'll try, and they'll do that by keeping this thing going a lot longer than it needs to. Unfortunately, there's no real way out to a more fundamentally stable economy and a fundamentally more stable currency than through a pretty painful recession. And that would require a real reduction, not just nominal, a real reduction in government spending at all levels. And, obviously a lot of layoffs, a lot of people would be hurt, a lot of people would probably lose their homes, a lot of people would be upside down on their mortgages, a lot of kids would probably move back in with their parents. I mean, it would be a very, very tough period, but I'd certainly rather have 24 months of that than 20 years of zombie economy, which is what I fear that in our country anyway, that Jerome Powell and company have planned for us. Because the bottom line is there's too much money and credit out there, And so that has hugely distortive effects. And so unless and until we turn that off, we're going to see what Austrians call malinvestment everywhere. And that is simply that when the cost of borrowing money, or not even necessarily borrowing to do, let's say, M&A activity, the cost of equity for a company to raise equity is so exceedingly low relative to inflation and other things that all kinds of businesses look good on paper, right? I mean, you're giving out free money. Okay, we'll merge these two pharmaceutical companies or whatever it might be, but it's only when we turn that off and allow interest rates to operate as they should, as a reflection of how much people want to borrow and how much people want to save on two sides of the coin. Until we find that interest rate, we're not really going to know the appetite for all this economic growth. So I would argue that GDP, inflation, unemployment, any number that you might want to hang your hat on as a statistical matter, as an economist, is artificial unless and until we get that number one fundamental price in the economy back something closer to a free market mechanism. And that fundamental price is basically the interest rates. Now, that would be different for prime borrowers versus subprime. We all get that. But, until we know the real cost of money, we can't really know the honest price of anything in society. And a lot of your listeners will know the name David Stockman. He is excellent on this point. I encourage you to read him. He's very wordy if you get his blog. You got to read a lot of words because it's like 2,000 words a day or something. But David Stockman is very, very, very good at explaining how the Fed funds rate is sort of the most important price in an economy. And since that's basically zero or close to it, it's getting close to one now, but how distortive that is all the way through ultimately to consumer prices. So, boy, I wish there were a soft landing out there. But if you expand, look at it this way: if you expand 200% and you pull back 150, that's pretty darn painful. But you're still 50 ahead of where you were, and that's the kind of thing we have to hope for here. But without money, and I think this is why Bitcoin is sort of a Hail Mary, without some sort of monetary discipline imposed by the marketplace on central bankers. And talking about the marketplace and central bankers is almost an oxymoron because, in my opinion, central banks represent centralized planning of money, which is a non-market function. In other words, they represent political money instead of market money. But nonetheless, if we could, unless until we get some degree of market discipline imposed, especially on the U.S. dollar, but on Western currencies more generally, I fear that the politically acceptable answer will be for these central bankers to try to keep this zombie going through injections another 20 years. You give a little bit more morphine to the junkie. So that I guess that would be my prediction in terms of if people are trying to think about how to advantage themselves.
Yeah. And it's interesting because the very last point you made about the morphine being given to the junkie, we all seem to be dependent on this expansion of money and credit, money being produced and then credit being multiplied by the banking system. And to your point, sometimes the best way to get off the medication, the best way not to become an alcoholic is to stay away from alcohol. The best way to correct alcoholism is not to hang out at the bar, right? And we
Yes.
can't. This cold turkey idea has really got to be something where we're like, are we okay with this as a culture, as a society?
Well, it's no fun being the politician who runs on the platform of cold turkey.
Yeah, I'll get 3 votes on that one.
Right.
So,
Absolutely.
Jeff, just to wrap up, what kind of things are you looking at for the Mises Institute? Where can people find you, your podcast, everything like that? Where can people track you down and get more information on the Austrian school? Mises himself. Share a little bit about where people can track you down.
Well, if you're interested in reading, we have a lifetime's worth of free reading, books, etc. at Mises.org, mises.org. And you can go and sign up for our weekly or daily emails and consume as much or as little economic education as you might want. You can find us on Twitter. You can find me on Twitter at Jeff Deist, all one word. And really, it's just a matter of educating yourself, I think, is a key component of protecting yourself, and it's a key component of investing. And if you're looking at things a little bit more from a monetary policy perspective than just a pure return perspective, it probably gives you a bit of a leg up as an investor, I would venture.
Yeah, I would 100% agree. And for people in Canada that want to delve deeper into how to combat your assets and put them in an inflationary protective hedge, in a tax hedge, you can find any information you want about our group at ibcanadagroup.ca. Well, Jeff, thank you very much for making the time today. And I look forward to seeing you again when you're back up in Vancouver mid-August. Well, hopefully
Yes.
We'll be meeting then. And been a Mises follower ever since I got red pilled from the finance industry. So thank you very much for what you do.
Excellent. Thanks, Mike.
Okay, cheers.
IB Canada Group, your independent authority for information on the infinite banking concept.